All right, Robert, it seems as if you've read your tea leaves correctly.
Well, we try. We like coffee. We like tea, the coffee grounds and the tea leaves.
And depending on what you like to drink, thank you for joining us on this episode of Real Estate Chat with
John de Perez.
and Robert E. So, jumping right into it, a couple of episodes ago, well, we can't take all the credit. Economists predicted a 25% chance of a rate hike, meaning more likely no rate hike would happen. And that's exactly what happened. Here you go. Bank of Canada maintains policy rate continues quantitative tightening. So basically, it held its target for the overnight rate at 5%. We'll link this article or this press release because no big deal, no surprises there. Make sure you subscribe to our channel so you don't miss any of these news announcements, whatnot. One of the most recent episodes we've had seems to have taken off just due to the nature of it, which is the housing bubble pop. And now that the Toronto Regional Real Estate Board has released August stats, we're going to see how close Robert got with his forecasts. And we're going to see what happens next because we are now in the midst of the fall market. Robert, take it away with your data.
Okay. Well, we continue to falter along, fumble along at 30%, 35% below normal. So, should it change in August? No. We had a fall off in August for CNE, so the CNE has a back having effect. And fortunately, if we can say that, we also have a shortage of listings. So we have a shortage of buyers, shortage of listing, balance, schmalance. Okay, here we look at prices, and this is the what I call school year. And way, way, way over on the right-hand side, we see a starred green, which shows a low point, and that's where we are now. And that's why this is done this way, so that you can see the low points that happen in August and September, and the low points that happen in December and January. And then you can see the humps that happen for the fall rally and the humps that happen for the spring. So it's the same information, same amount off of the average 10-year and the same amount off a hot market. So it's just looked at a different way.
So if this follows the same pattern, we should see the fall market elevate in terms of the amount of sales.
Well, we should see an increase from what we saw, but we probably will end up still being 30% off of the average because the average will go up too.
That's right.
Okay, so here we are, a record price again for August, the record price for the Toronto Real Estate Board, only by a smidgen and down from the month before, but it's a record price of $1,082,000. I thought it was going to go up a bit, but it came down a bit. And but we're still above. We haven't broken down through the price line. So good. We're 81% of the peak, and we're up 4% from January. So all of that nonsense that happened, I called it a blip, how unkind, but it seems to have gone away.
Exactly. So the interesting thing to see will be if it goes over this mark, which is the September figure. What do you think is going to happen, Robert? Do you think that based on the Bank of Canada not increasing the cost of borrowing, do you think that based on the levels of inventory and sales that we were seeing go into this fall market, what do you think will happen with price here?
I am going to say it will remain over $1 million as an average, and the mix, well, I think it'll just stay flat around there. It might go to 950, and it could break down, it could go flat. It's not a strong year. People are not feeling positive. And that's why Buddy Boy decided he wasn't going to make a move up, even though he wanted to, even though he continued quantitative easing, which is quite an important factor that nobody's talking about. And even because in the middle of the notes, he says, but we'll do it if we have to.
Exactly. They've left the door wide open for that. And the interesting to point out is that when you see that earlier this year, there was a pop in terms of the spring pop in a good way. Spring market prices went up. This was prior to this was in the midst of the spring market prior to the successive rate hikes, right, Robert? So now with those rate hikes factored in, I don't think we're as confident to see it elevate to those previous levels at this point.
Sometimes there's not much of a fall rally. Like maybe people are exhausted. Maybe a lot of people accelerated their purchases when they saw everything going cuckoo in late February, March, April, and a bit of May. Who knows? So it's not going to be terrible. But again, if you want to sell, put your property up.
But we're not going to see a bubble pop. We're not going to see a bubble burst at this point, are we?
Well, again, it's in nobody's best interest, including the lenders and including the government, for real estate values to fall apart. It's in nobody's best interest. So that will likely not happen. If people don't like the conditions, they will remove their property from the market and not sell.
All right. So now let's look at when you remove the peak year, September 21 to August 2022. What do we see here, Robert?
So this is a 2-year transition. So the heavier black line with green dots is 2 years ago. And again, it's the spring, it's the school year. So it starts at September and goes through to August. So we just finished one off. But the dramatic difference is not so much. Even though it's a 2-year change, it shows the pattern a little bit better.
We're practically back to 2021 levels at this point, just slightly above August 2021 levels.
Correct. 2 years, yeah. So this is what this one shows as well, that if you look at a year ago, if you look at a month ago, if you look from the peak, it sort of tells you there, and there's a guess into the future if things continue to change at 1% down a month, where we'd end up. It's a guess. It's the next slide along shows us in a different way that's a little easier to comprehend, that here's all the peaks at once. And our red line is the bouncy, very bouncy. You can see the spring. And now we're back to where we were a little while ago, which we were saying, like it's up 4% from January. So what are we going to see next? Are we going to see sort of a lateral move where prices are going nowhere, but they're not going down and they're not going up? Good chance.
So we're at 81.11% of peak February 2022 and 33% of sales and averages. So some have called this a crash. Some of them are saying that there's more to come. And
well, no, you see, you have to look on both sides of the peak. That it can only be a crash if it completely destroys the other shoulder. It hasn't destroyed the other shoulder, and it normally doesn't destroy the other shoulder. It just settles out at the other shoulder.
Yeah.
I know this is one that I was using when I thought that things were going to really go down. But what it shows, because there was a nice article in the Financial Post from a girl who talks about a lot of things, and it was prompted by, I guess, a news release that came out of Zoocasa, which is a website parading around as a real estate broker. But they did come up with a good thing. They picked a nice time in 2018, which is sort of like the previous low, and said, look how much prices have gone up, even if they take today's 10.082, which is much less than it was once at 1.33. But if you go down and sort of in the middle of the page, then you see that it was quite a bit lower, between 700 and 800, not too long ago. So this one says, what happens if things continue the way it did for a year at 1%? I'm going to say that since we've had an average of minus 1.111 since February till now, that could continue. And so we might end up a year from now, or a little 14 months from now, at 9.2. And I don't think anybody would be overjoyed at that, but there's the 31% that the other chart indicates. So all things are possible. I think that's time for creative financing. We're going to have a time for real knowledgeable buyer and seller representatives to put a deal together. No more order taking. You got to work on something. You got to you really work if you're the realtor involved.
Well, let's play on this idea for a bit for those who love the scenario of, the bubble will burst this time. This time it's different. Let's say we did drop to 921,700 as the average price. What would immediately happen in that market, Robert?
Well, nothing would happen. The people who bought in 1953 or 1968 or 2003 would say, well, gee, I guess I don't have as much money. But if it continued that long, it would mean that they've kept this high interest cycle going that long. And it would mean that perhaps we've had some of these prices come down, some of these prices not increase, some of these prices they're fueled by government intervention and tax may be withdrawn, because they'll say, oh, everything we're doing on the interest rate and the quantitative easing is not really working. What can we do to make this work? But they're not going to do that.
Well, that would be catastrophic. Now, one thing that's very interesting to point out is we've seen this from about the early to mid 2020s hit peak. And if it were to come back down, we'd be back at early to mid 2020s. That's a huge spike and then drop. Wouldn't some of our viewers who've clicked like on this video, if they like what they hear so far and like what they see so far, wouldn't they say that, hey, Robert, actually, that's okay. I'd be happy with 921,700 as the average price. Of course, the peak buyers would be suffering if that were to
Yes.
happen. But anybody who
Yep.
had bought at 2017, well, mind you, 2017, you'd still be at break even. So anybody bought here is in a pretty dangerous position, don't you think?
Well, they're overextended. They're underwater. A lot of those were spec buyers. A lot of those people sold a house though at the same kind of a high price in order to buy at that high price. So they're just like two corks floating on the ocean. Their net equity, the amount of mortgage that they have, is probably the same or a little bit more than what they always intended. The difference here is the interest rates. And there was an observation by, I wish we could attribute it to somebody, who said they bought the payment. Just like a leased car. Somebody during the boom said, things are going up. I don't want to miss out. And they said, look how affordable it is at 1.85 on these variable rate mortgages. I can be approved and I'm going to do it. And, they just got the last gasp of a boom.
Well, one more thing before we leave this idea here is
Yep.
that on the way up, some speculators have borrowed against their equity. Let's say they bought a few years previous, they borrowed against their equity, bought another house,
Yep.
maybe
Yep.
at
Yep.
this point, maybe they bought another house. Now they've
Yep.
bought three properties. If we hit that, those two houses are both underwater, plus their primary residence would be suffering because their equity would be obliterated from that. Wouldn't that be true?
Well, if they borrowed against their primary residence, they're not investors, they're speculators, and unfortunately, they're going to pay the price. But they just get rid of the two, new investments. And since they were investments, they weren't principal residents. They can, even if they sell them at a loss, they can write that off as a capital loss against other income. And, they won't have made any, but they'll have an adventure in the real estate business and be wiser next time.
Well, let's just hope everything goes fine and dandy at this point and we don't see sub 1 million in terms of average price. So let's look at inventory and what that story tells us.
Okay, inventory is barely, we looked at this a couple of weeks ago, barely where it should be. And so that means that things are piling up and not selling as fast as they're being sold.
Is that something to be worried about though?
Well, no, it's when you have way too much, and the barometer, because we have sales down, listings down, the barometer is months of inventory. So it's 2.9 months of inventory, which is, it's not 4%. If it was 4 months of inventory, we'd start scratching our head saying, oh, what's coming? If we had 8 months of inventory, we'd know that we're in a terrible time.
So on the supply side of the equation, it's still a bit of time before we should be worried. We're just going back to what normal markets should look like. And as long as there's enough sales to absorb inventory coming in, we won't see a downward pressure in price.
Well, the inventory is only at average because we have such a low number of sales. And that's why we have 3 as the months of inventory. Sales are the problem. There's not enough sales.
Okay. So let's look at that. New listings.
Okay, new listings. This is one of the unfortunate things that the Toronto Real Estate Board has decided that they are not going to they're going to keep track, but they're not going to really promote the fact that some of these listings are do-overs. And this 2 charts, 2 lines shows the difference between, if we counted everything only once, we would see that the number of listings is really way down below average. That the number of listings should be those 2 dotted lines somewhere around 12 something, but really we're only getting 9.2. So the number of listings is way down, just like the number of sales is way down. But when you count the do-overs as new, it's hidden.
Which makes sense because we're looking at a sales to new listings ratio about half right now. So for every new listing, half sells. But this would imply that it's less than half actually. But depending on the number of new listings come in September, we'll have to track this number and figure out.
This next one shows you it's the opposite of that. You see, what is the standard method says that 43% of the listings are being sold. But in reality, if you subtract the do-overs, you can't count them twice.
No.
We actually have a more of a balanced market condition. 57% of the net listings are selling as a percentage of, or the sales are 57% of the net listings. So we're all lost in this whole what's really a new listing, and it's not held off the market for 5 days and coming soon, and everybody's saying, what do we do to make things go back to normal? It's just not going to go back to normal very fast. Okay, here's the same thing with the months of inventory, 2.93. And it's not bad. You can see way on the other side, December '08 there was 8 months of inventory and nobody wanted to do anything because there was no confidence. Now we have okay confidence, but nobody wants to pay the rate, and nobody wants to pay the price on the rate.
So it's one or the other. I mean, again, go back to our bubble episode 1 episode ago, and we had a very much interesting discussion between those who say, yeah, the bubble is bursting, this time is different, and those who say that, look, there's so many different variables and factors that's going to prevent such a thing from happening. And we've seen worse conditions than this, Robert, right? And, interest rates controlled by the government, of course, and these rate hikes can be undone at some point if things were to go bad.
Well, unfortunately, we had to shorten the time here. When Ronnie comes up with his statistics that goes back to 1990 and 1985 or something or other, when we can see the other spikes of interest rates and what they did to months of inventory. This one in December of '08, we never want to go through that where the whole world's money nearly blew up. But again, that was unsettling to anybody who had a mortgage and had a job and who had to make payments.
Interesting.
Okay, so days on the market, we know that it's up and we know that it's down. Both of them are edging up, which means it's not as fast paced as it was. And we already knew that. So, maybe that's the same thing twice. Sorry.
Conclusion.
We've had a summer. We're heading into a fall. The fall market starts next Saturday, a couple of days from now. And the U.S. is going to have come up with an interest rate announcement one of these days, and then our Tiffany is going to follow that pretty closely. And unless there's a huge bad thing that happens, they're just going to coast along with this throttling the economy as long as they can until something bad really happens, and they say, I guess we can't throttle it anymore. And they're throttling based on, it was okay back then, so let's keep doing what we're doing right now. It's like you're choking the guy, and he's gasping, but you can't see him gasp because you're like, you didn't mind it a couple months ago.
No bubble.
Well, they could throttle it forever for a long time,
so
as if they're somehow immune to it, as if there's never going to be another election.
So it's inflating, deflating until they figure out what's right. Fall rally, fall flop, or fall flat, Robert?
Well, it's an opportunity for anybody who wants to sell with not a lot for sale and competition. And there's a time to buy when there's many more homes for sale in every single price range than there was back in the spring.
And this is, the irony of this, Robert, is for our viewers who were actively in the market or maybe sat in the sidelines. Correct me if I'm wrong, Robert. This is what buyers were praying for. This is what buyers wanted. Now, they didn't want the interest rate, obviously, but they wanted the time to think, the time to breathe, the time to look over options, the time to select their house. And I'm looking at, Robert and I, we look at listings every single day, and I'm scratching my head and I'm like, some of these listings should not be on the market for 30 days. Because in the high times, they would have been gobbled up in a day or two. Couple of hours for
again with this artificially low pricing. Now nobody knows whether to trust an asking price or not, because some of them coming on at 20% under, 10% under, 5% under, or they're having a future day when they're right on the money where they should be at 100%. And so people are saying, well, better wait till the day goes by till we actually see this guy acclimatize himself and decide what he wants. And once he decides what he wants, then I can deal with it.
Well, that's the interesting thing, Robert, is the ones that do have that future set date and are listed at a discount, and people think I'm referring not even to those listings, just listings that are at market at this point and still sitting. And these are houses that would otherwise not have sat around in the market. So in essence, no bubble here, maybe inflation, deflation of home prices. Who knows what's going to happen? And we should see, maybe steady is the right word for it, Robert. There will be sales. There might be some price increases going on, but there's opportunities in the fall market ahead.
Well, again, the whole market, who cares? You are only looking at one house that you want to buy, one house that you want to sell, one investment property that you want to divest. So it's your money. It's how you're applying it. Would you rather have it in your pocket? What are you going to do with it if you do sell it? And it's a time where people are just being very cautious. So,
there you go.
There's
So
no
make sure
overall
you-
trend apart from that.
Make sure you do your research, do what's right for you, subscribe and click like. Make sure you leave in the comments as well what you think about this and our previous episodes. Make sure to check them out. Thanks for watching Real Estate Chat. Take care and bye for now.
See you later.